Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Service International Limited. Here's your weekly technical analysis of LME 3-month nickel and zinc. I'll start with LME 3-month nickel. It didn't take long, it really didn't. I've been speaking now for months about a theory I have about why the market halted in the 26,000 area back in May when there didn't seem to be any sizable support located there. It all relates to the August 2011 high at 25,195. Now this is an interesting level. Other than the fact it was a significant high in the past, it was also the approximate start level from where the original huge rally in March started from and its subsequent ghost highs. Hence, we would end up back to where the market started back in late February, and it was the market's approach to these levels that prompted a premeditated response at a slightly higher level, indeed at the next higher round number level of 26,000, in anticipation of this very important 25,195 level being tested. Anyway, the first test down to the 26,000 level in mid-May held up prices for 2 weeks before turning the market back up again. However, this was not the change in trend that some anticipated, but a pullback up before we saw a fresh attempt lower. And that was 2 weeks ago. This time the 26,000 level gave way and the key level of 25,195 was tested for a total of 6 sessions before the market finally broke down through it last Wednesday to the next support level, the slowly rising long moving average, currently at 24,290. All this lasted just 1 day, as the damage had already been done back at the market breaking the back of the 25,195 level. We then saw a drop last Friday, all the way through the February 2014 high at 22,155, closing just below it. Before I deal with this week's actions, I would like to remind you of part of my commentary from last week, and I quote, "You see, a little below we now have a potential new target X2." That was in the 22,000 area. But a potential action of April today being a possible bearish halfway hesitation. This is in many ways a prospective target below, but it's a potential one should 25,195 properly break. And that's the end of the quote. Well, as you can see, the target X2 in the 22,000 area was enough of a target below to justify last Friday's actions and overshoot on the downside. Indeed, it was gratifying to see the market reach target X2 and turn back up almost immediately. So what's next? Well, I've drawn a prospective bearish Andrews pitchfork for the mid-April to late May action. This is quite narrow, and I expect it may have to finesse it or even retire it for something else in the meantime. But in the meantime, it will do. The market is currently in just over the middle time. That's currently at 23,090. LME 3-month zinc. There continues to be a lot of interesting things going on here right now. First off, the context. I've previously spoken about how I had on occasion taken a step back and looked at the monthly charts to get a better picture. From these I noticed a significant pattern still in operation plus a second pattern that was forming. The principal pattern was the 2015-2020 bullish Andrews pitchfork. Most recent events involving this pitchfork was 4 weeks ago when the market moved up to the combination of the middle time, which is currently 39.77, plus the March to May 50% Fibonacci line at 39.96, as well as the then flatlining short medium moving average, that's currently at 38.51. This is where prices halted, hesitated, and then headed back down again, which we're still seeing the effects of today. Now, looking a little more closely at certain elements. In mid-May, the market had dropped down to the combination of the rising long moving average, that's currently at 35.98, and kissed the lower trend line, currently 35.41, of the second large pattern that was being formed on the longer term charts. This lower trend line was from a very large ascending, expanding wedge pattern. After doing this back then, the market immediately reverted back up again. Now, this second pattern does require some work on your part, as it would require you to ignore part of March's action, specifically the top of the huge spike on the 8th of March. This spike pierced but did not close over the upper trend line of this 2020 to date ascending, expanding wedge pattern. Last Thursday, the market punched down and closed below the lower trend line, and we've moved lower since. We've so far had 3 closes below, which is enough time to place some prospective targets below. A primary target, this is going to be X with a question mark, is way lower in the 2082 area and off the bottom of my daily chart. It would be fair to treat this, at the very least, as a longer term target. And upon reflection, I'm not happy just yet to place a secondary harder to get target, not just yet. However, there are a few more patterns that I'd like to discuss, one of which I introduced last week, and that is the prospective March to April bearish shift pitchfork. This pitchfork has not had either the upper or lower time tested as yet, and until it does, it will remain prospective. The one time that has seen action, especially since May, has been the middle time, currently 34.02. Additionally, I saw last time the argument for a new bearish shift pitchfork for the mid-April to late May action. This week I have drawn this pitchfork on the daily chart. The market is currently in between the middle time below, that's currently at 32.48, and the upper time above, currently 36.32. This brings me to the last pattern I'd like to discuss. Last week I laid out the possibility of the action since mid-April today could be either a double bottom or a bearish halfway hesitation. It was too early last week to see which may be finally formed, but this week the market has dropped in favour of a possible bearish halfway hesitation. This pattern would have a possible target X in the 29.15 area, and that's marked on the daily chart. Now, the main obstacle to the market's journey lower is, oddly enough, a pair of old congestions. The first one is the old bearish bump and run reversal trend line from August to October last year. It's currently at 33.23. The second one is the 50% Fibonacci of the March 20, March 22 move at 33.29. These two have halted the move lower from the wedge pattern. Now, do I think they can halt the market? Well, yes, they can. Do I think they can turn the market back up again? Well, not at this time, but it is worth watching them closely to see what happens. There's one final observation I'd like to make. We have just had a dead cross of the short medium moving average, currently at 38.52, down through the slowly declining medium moving average, currently 38.53. This is a lagging indicator, but it should be kept in mind in relation to future market developments. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright ZD Tofpik and ADM Investor Services International Limited. And here comes the final bit.